the closing beat, everybody. Happy Wednesday. Wednesday already, man. Shoot, just a couple more, no, 2 days to go. We'll be in December. My goodness, man. It goes quicker. You get kids, it goes quicker when you get a little older. And by the way, cold as can be, right? I'm going to share something with you guys. You guys usually see from here to here, right? I'll share something. One of our clients, old Cliff, a couple years ago, I'm wearing these now. He got me these. These are camouflage insulated Crocs. And when this time of year comes around, I don't know if you've been in our studio here, but the floor gets cold. So your boy walks around in these camouflage Crocs, happy as can be. I'm just, love it. We are financial advisors that apparently wear these things inside and out of the office. We play chess, not checkers. And one of the cool things I worked on with a client today, I like to share these things with you. If you hate it, it's fine. But if you have an ETF that pays out some dividend and some redistribution of your initial contribution, right? There are a lot of ETFs that do that. You'll see it on your forms there. So we worked out a plan where they could take the money from the dividends, put a little off to the side, and by the time they got to a zero basis on their ETF, they could donate that ETF to a donor-advised fund, keep generating the income and dividends and everything, and then donate it, then have enough cash to come back and reestablish that position so they could live off the dividends. I had never done that before for somebody. I was like, yes, now we're thinking, man, deep level stuff. Anyways, our Wine and Wealth class this week will be on some updates. Lots of cool updates coming here to Jazz Wealth, and with our integration with Goldman Sachs, we get all the fancy stuff now that the rich people get, but you don't have to be rich to get it. So I want to share a few of those cool things with you because, man, just stuff I never thought we'd be able to actually offer and get away with it. With that comes a lot of education because, you're supposed to have that knowledge of that. So I will be teaching more and more about those things as we go. Thursday is one of them. If you're a client, it'll be 8 o'clock in the dojo. Well, if you got the S&P here, you got some good and bad. No real ugly today as far as the indices are concerned there. The S&P is on pace to gain, well, at one point, it was on pace to gain 9%. For the month, just for the month. Think about it. What it normally can do in a whole year on average, if you go back far enough, 9%, it's going to do that in the whole month there. And by the way, I want to point out, it did it almost within the expected range. Remember, we took a different look at this in the past. We said, well, what is the average distance between the high and the low? Maybe, so for example, January, maybe it doesn't gain 5.9%, but the difference between the low of the month and the high of the month averages 5.9%. So in other words, we're gauging volatility. January can be a more volatile month and likely will be this year, coming up next year, sorry. And as you work your way through the summer, you can see how the range gets smaller. The market doesn't really attempt to move inside of a large range. Well, we talked about this in October because that's the biggest month, right? As far as the range goes, what did we have? We had the biggest range of the year in October. So the market, once again, behaving pretty much like it likes to behave. Well, November has about a 6% range, and we're just outside of that if you want to factor in where we started. There really was not much of a pullback this month, really. And so really, really cool. Now, what we have here is December being the lowest, or coming up on December, being the lowest range on average month, right? So about a 4.7% range. So while January has a range like this, you basically have December muted and a little bit calmer, and that's because of the holiday weeks and stuff. Basically 2 weeks of the month are kind of like, it's what it is. So I thought that was really, really cool. Now, one of the things, should we? Okay, I'm going to share something with you in a second. Let me move on to everything else here and kind of get into this. Inside the S&P today, real estate, another good move for real estate. Real estate was actually your leading sector, almost gaining 1% on the day, 0.75%, and that has a lot to do with bonds. Right, so bonds are continuing to come off of lows. We love that. Right? I don't know that this is an investable moment for bonds necessarily, but they're coming off of those lows, and it continues. Very few of these types of days right here, where it looks like you're going to accomplish something, and the very next day it erases all of that. We're not seeing that so much anymore, meaning the sellers aren't dominating the buyers anymore, and that's all the rigmarole out there with what the Fed is considering doing and all that stuff. So basically, that's helpful for real estate. Right? They live and die based on interest rates. And so really, really cool there. It's your leader today, and it's your second best performer over the last month, meaning this from here to here has accomplished more than all but one other sector in the S&P. On the downside, on the downside here, you got energy continuing to be the weak spot. Like I said yesterday, I don't know that this is time to buy it just yet. I like buying pullbacks, but I'm really sort of hard. I don't have the skill set there. I don't have the eyes or the feel for it. But nonetheless, it is basically taken the day off. It was not the worst performer here today. Consumer staples was actually the worst performer, as it is also pulling back in the short term. Okay. Looking at the NASDAQ here, you didn't have your big participants today. I don't know how to say it. We started off with most of the NASDAQ trying to get going, but then the big guys weren't participating. So look around, you got Microsoft didn't even once try to participate today in that rally. It just basically put in its high from the open, and that was it. Apple gave you a little shot at the start of the day and started selling off. Alphabet, there you go. Same thing. Started selling off. They're so big, even in the S&P, there's so much of a weighting of those stocks in each index there that it just wasn't going to happen. There wasn't going to be a big, magnificent rally here today. Add to that, we know we're getting heavy. We could see it clear as day in the S&P. When we tried to rally today, that was people going, all right, enough's enough. Come on. I've got a nice profit here or whatever, or wherever I stand, it looks good. I'm going to take some profits off. Or maybe balance that out with some losses. It's getting into tax loss harvesting time of year. And that's why you see this topping tail here in the short term. So getting heavy, and I would say even heavier in the markets there. The NASDAQ also, you don't look at that and panic. You know what I mean? Sometimes you look at something and you go, that don't look good. You know, that's a rough one there. You look at this and you say, well, give them a break. They're up 12% for the month and 46% year to date. Okay, I'll give you a break. You know what I mean? Over in small caps here today, that's where all your action was, even despite the pullback throughout the day. Small cap value, small cap growth, the index as well, outperforming every other what we call factor in the market. You know, when somebody says, I'm a small cap value investor, that's a factor of the market. It's not an index. There's no index, right? Or in that case. So you would say, well, I'm a large cap growth investor. Okay, that's a factor of the market. That's what you've chosen. Well, today, small cap everything beat anywhere else, okay? Really cool there. Oh, let me go back to the 10-year real quick. So because of this rally here, the 10-year actually gets below 4.3%, actually 4.25%. So nice little pullback there. It was just 5, right? We were just over 5% actually. And so, all right, we're making good progress there for those of you that want to utilize debt, in particular, mortgages. Real estate, we already talked about there, 12% in 1 month. Fun fact, we have our own funds here at Jazz that we build for clients. Our real estate fund is also up 12% in 1 month. I'll just point this out again from my little rant yesterday. That's more than large cap, right? So everybody that's chasing large cap, you actually just lost out on some of the returns from that. So be very careful if you're going to fall for the large cap stuff. All right. Let's try something. A little bit of a lesson because things are kind of quiet out there. Then I'll do stocks in the news, take your questions there. Got a really cool stocks in the news here coming up. Okay, so the S&P basically is going to gain 9% in a month. So I wanted to try something here, and I'm going to try it again because it didn't quite do its thing. All right, we're going to use our research site. I'm going to use the SPY because I know a lot of people know that. You want to use it. I'm going to say 9%. I've already done this, so I'm just doing this for you. We're doing a calendar search in this case. It's a little shrunken, but I'm saying the SPY, show me any calendar month where it was up more than 9% over the last 30 years. Whereas normally I'm up here, I use the rolling search. Just show me any period where this happened. All right, so first thing you notice here is the S&P gaining 9% in a month. It is odd, right? There's 1, 2, 3, 6 times that it's happened there, okay? Don't just, when someone gives you stats about an insurance product or an investment or a business, an opportunity, whatever it is, don't just take the stats. Take a second to look a little bit deeper. We know that when it gains 1% in a calendar month, the next month has a 50-50 shot of being positive. We know that it's December. December averages a nice little grind higher. There could be a pullback in the beginning, and that's fine. But overall, we have a 50% chance of a small rally. Average, basically 1%. So we don't have a 70% chance of an average 7% rally. You notice how they're not big numbers. In other words, it takes a lot of effort to get the market to do that. Let's take it another step further. Look at the dates. March 20, 2000. Was that good times or bad times? That was a declining time in the market. Okay. 2009, was that a declining time in the market? Yes, sir, it was, right? October 2011, same concept. 2020, you guys know what was going on then. The end of 2020, you obviously know the world we were living in then. And July 2022. This one I wasn't so sure about, but let's try this. So the 9% gains come during declining markets. I wanted to illustrate this for you here and try to show what this looks like. So we're going to come back over here. Here is the July 2022. They all look the same, by the way. You pick any one of these, you'll see the same thing. The stock market was declining into the 9% rally. What does that matter? Does it mean, who cares, right? It goes back to the same thing I've been saying here, and I've shared all kinds of data with you, that the biggest moves in the stock markets come after pullbacks. The biggest moves in the stock market don't often come after having some magnificent run. This goes back to my large cap discussion yesterday. Why would the biggest move in large caps come after it's already had one of the biggest moves it's already had? It just doesn't do that. Who buys that? Where's the momentum? How do you keep people excited? It's like a Taylor Swift ticket. Put it up for $100, someone will pay $2. Someone will pay $4. Someone will pay $6. Someone will pay $1,000 to sit in the nosebleed section, right? Someone's not going to pay $40,000 to sit in the nosebleed. You get what I'm saying? So take a look at what we had. We had basically a rally off lows. People found discounts. They weathered the storm. They were happy and excited to buy something cheaper. If a price of something is declining, more often than not, I've done the example on Michael Jordan's house he's been trying to sell forever. If the price declined enough, there would be more people that tried to buy it. Same thing in the stock market. Well, wouldn't you know it, we have now what will be presumably will be our 7th month where we gained 9%. Did it come after a period of rallying? No, right? So if large caps looked like this, and then even gave you a rally, all right, I could understand. Next pullback, I want to be a part of that. I don't have to guess that it's going to stop dropping. I don't have to guess that people want to buy. All that's out of the way. I will buy the next pullback. All right, maybe that's your mindset. That's fine. But when you look at the stock market doing this, you will not get the 9% returns if you do not watch or participate or somehow stick around to see the pullback there. So very, 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 very cool to see that data. All right. Moving on. I owe you some stocks in the news. Do I not? I do. So let's get started here. This is so cool what's happened today, right? And it's another one of those things. You got to just look one little bit layer deeper. This is so cool. Check this out. General Motors. We happen to own it now. And so, okay, great. We're happy to see it make the rally here. General Motors, they basically raised their dividend a little bit. Right? And they're going to buy back $10 billion worth of shares. What have we talked about numerous times? I probably can't find it fast enough. But when the economy is on the backside of the growth curve, investors want to see you buy back shares. If you buy back shares, your stock price gets rewarded. It's as simple as that. We've talked about that and shared numerous examples, right? But what's going on underneath the surface with General Motors? This is a great example of how you treat your personal finances like a company treats their finances in order to survive, right? We're all surviving personally with our dollars. These guys are trying to build a company and grow with their dollars. What happened? Well, the UAW came after them, right? They had an unknown period of strikes. This could go on for weeks, months, years. We don't know. Unknown period. What did they do? They said, we may not need it, but we're going to open up lines of credit in case we need that money to survive, not to spend on a new luxury, whatever this or that, to survive. They had these lines of credit and said, if we got to use them, which they did use some of it, then the interest that we pay is the sacrifice that we'll make in order to survive, right? And give us some, hopefully, bargaining power there. So the reason that they're buying back $10 billion worth of shares and paying you a little bit more in a dividend there, I think 11 cents now versus 9 cents, so it's not much, but something extra there, is because the strike is over. We no longer need the lines of credit. Shut them down, lower their limits, keep them but put them at next to nothing, right? Don't pay interest on that stuff. We don't need it. We're in good shape. I love that because if you think about it, your life, you go, oh, it looks like they're laying off people at work. I may get in trouble. Set up a line of credit, a home equity line of credit, for example, just as something. You don't have to use it. Maybe you use a little bit of it, and that interest you pay, so be it. You pay it, right? You had to survive. These guys think, I mean, it's just so much to learn there. It's incredible. All right, Foot Locker. So this was all over the place today. Foot Locker, this was not that impressive in my mind here, but everybody looked at Foot Locker and said, oh my God, I guess we need to participate in this one. Earnings beat their lowered expectations. So they already said, you want us to be here? How about we agree on this number? And then they went just above that number. It was still less, but for whatever reason, people were excited. Now, we don't own Foot Locker, but we do, excuse me, we do own a stock that participates in that space, and the rally today on that stock, this is our best performer today, was purely because of Foot Locker. Just fascinating. We didn't have to do anything. All right. By the way, can I go back a second? I don't know the answer to this. Honestly, I haven't really researched it, but remember when Biden said, we don't like that companies are buying back their shares? That's not an effective use of dollars in terms of, for the average shareholder. Well, first of all, I would disagree because we've proven it time and time again. You can see it. You can see the impact. But remember when they said that, and they said there's going to be a 1% surcharge tax, right? 1% flat tax on share buybacks. That became the law that's currently existing. Are they just paying that? Where's that money? I'm curious about that. Do we just have it somewhere? You see all these companies that are like fired up to do share buybacks. Are they just paying the 1%? That's not a big deal. That's not a lot, I guess, 1%, but it's a lot of dollars. Anyways, I don't know the answer to that. That's one of those things that when I get free time, I'm going to check it out. All right, CSX. So this falls into the, what do you call it? Private equity side of things. You notice there's a lot more of that going on. So, I'm sorry, that's the wrong symbol. I said CSX. It is not. It's Phillips 66. I was thinking not the railroad, the oil company. So the stock higher today. Basically, what you have there is they're very popular. Elliott Capital Management taking a stake. They're getting involved in this company here, and they're like, we want to start making some decisions. A lot of that going on, right? I'm not sure I know why, but I just noticed that picks up. It's kind of like when you notice companies filing for IPOs, just more and more and more. What's going on? That's starting to happen. The last couple of days especially too, right? You've seen me talk about it. All right, Dollar Tree here. This was a miss. This was purely a miss for them here. Dollar Tree sales up, Family Dollar sales down. And so the miss was all because of Family Dollar. You take that out of the equation, it's not too bad. But speaking of bad, here you go. This goes back to my comments we just made about General Motors. All right, Petco. You've seen a Petco. They probably have them everywhere. We are now going to be talking bankruptcy for Petco. Today, their earnings report basically solidifies that is coming, whether it's tomorrow or the next month. I'll make one of those predictions there. This is the discussion we're having. They lost 5 cents a share, meaning they didn't make any money. They're expected to lose only 2 cents a share. And you go, okay, but that's not such a big deal. Why are we talking bankruptcy? They have too much debt. They have way too much debt, and they have next to no cash flow coming in. If you are a fundamental analyst, and that's what you do, you agree. You look at the same thing. You bring in billions, but you only made 30 million. They give 30 million in revenue. There's no cash flow there. Unfortunately, they're in a little bit of trouble. What's the personal lesson there? Use debt when you can, not when you have to. If you're one that believes in debt and you're okay having it, right? Use it when you can. Because if you use it when you have to, like these guys are going to have to utilize debt if they want to survive, it's going to cost you. It's going to cost you. So these guys did not do very well, in my humble opinion. But that's what we got. Okay. Take your questions if you have any there. And in the meantime, while I'm waiting for that to catch up, tomorrow's earnings, we will continue with the retail earnings. It's just that time of year. Big Lots, Cracker Barrel, Kroger, Ulta, the store, Zoomies, and that's pretty much it. I believe Sleep Number, we were talking about the S&P 600 the other day. Sleep Number is getting the boot. They're getting kicked out of the S&P 600, FYI. That will take place next week. All right. Let us see. Load up the thingy here. See what we got there. We got big executives selling shares of NVIDIA. Are they dumb? You know, like if you had to, it kind of sucks to do it this time of year for them, but you know, would you not do the same thing? I would. New Year's resolution, be a member of the jazz club. Hey, I like that. Why didn't we think of that? The jazz club. Okay. Yeah, we don't have a jazz club. I'm sorry. I don't know. I don't know what you mean, but I might use that. It's kind of, it was right on the nose. How did I not think of that? Palo Alto over there, Denver over there. Awesome. It is a rather boring week for the stock market. Most people don't pay attention this week. Then they come back, they start paying attention for the next couple of weeks. And then all of a sudden, you know, it's Christmas, it's the holidays, it's New Year's, it's all of that. And people start to take the last of their vacation and all of that good stuff. So it will get quiet again. So we're going to use this time to provide the lessons, right? Go a little bit deeper on things instead of just covering the day's events, right? Yeah. I can't tell you if it's the right time to buy a particular stock. I don't know why you would look at this particular stock. I'll give you like just sort of a general overview. Someone that would be looking at this to buy, the price is back into a range where it did not reward or penalize you before. Yeah, temporarily, I guess, but inside of this range, your money basically did not grow or lose value. We don't want that. We want to know that if we put money to work, there's a reasonable expectation of seeing it rise. You could be wrong and have to wait it out a little bit, but we want something there. And to see this ahead of time and go, I don't know, it went up and then gave it all back, then lost some, then came all the way back. You know what I mean? A little tough to wrap your head around, for me anyways. Looks like money is rotating to XLF, starting a position. Yeah, I would say that. Financials and real estate are the kind of, well, and you understand why. I mean, why money would be going there. And actually, side topic here, utilities had one of the bigger pullbacks today, and I didn't catch why, because they did not participate in today's excitement there. You're looking to start a position on Aflac. All right, you like the old Aflac thing? So on pullbacks, so look what Tom's doing. He's just saying, this is a stock that, like Progressive, right? They've just proven that they're steady and they're going to more than participate than what the market is doing with less volatility. So Tom's saying, hey, I'm going to assume that this momentum does not end and in fact may continue because money now has proven to rotate into the big financials as a whole. And so that's his belief. If it pulls back, he would like to start in this case, an options position to do it. So when you look at something like that, how can you tell Tom he's wrong? He may be. That could be the actual top, but you could have said that here, anywhere, right? So I don't disagree with someone who wants to play momentum. It's not my cup of tea. I always believe that that's the top. That's my flaw. But you know, you can't blame someone for saying, I'm playing momentum until the momentum proves that it is done, right? Plantair on the NASDAQ, and no, they got something else too, didn't they? Where did I see so much in a day? That might have been yesterday. I have to get back to you on that one. There was something else about them too. They get put in another index, but otherwise, yeah, it's an obvious fit. Yeah, the puppy's walking around, man. Just finished his bone and doing his thing. Is there a puppy cam? Oh, you do. Cody's all ready. So I'll get the camera. Hold on. Let me go get the camera and I'll put him on there if you want to see the puppy. He's all fired up about it. Get your butt over here. Oh, the leaderboard here. Is this up to date? Yeah. While you're doing that, I will say the leaderboard there, 35,350. Okay. So we got Linnea, Mark, Andrew, Victor, H, and Bruce still hovering around there. Bruce, a recent winner, actually. So, Linnea?
I like that, yeah. No, I like the way you pronounced it.
Linnea? Did I say Linnea? Linnea. It would help. If we knew their last name, it might help get us closer. You know?
It's Linnea B.
Oh, okay. Well, Linnea, congratulations. If you want to play, go to jazzwealth.com/guess the Dow. You are welcome to play. There's no strings attached. We won't sell your email. We won't even market to you. Opinion on the Las Vegas Sands. I kept seeing them today. It was like the Las Vegas Sands and Foot Locker day. So big down day. CEO selling shares seems overdone. Prime to bounce hard. Really? I mean, so for me, why is it right here? I'm not discounting you. I'm just saying, why would right here be the moment that with the fresh news and everything, it's just going to turn around? And if it does turn around, you go, okay, maybe I get a couple days out of it. But is that worthwhile? What's the risk to reward there? You have the reward of potentially like 48 in the short term. I don't know what your goals are. And you have the risk of like 43 and a half or something like that. So we're about even risk to reward. So that's kind of where I'm at on that one. And unfortunately, there's a lot of stocks right now that you look at it and say, well, look, I'm a year-long investor, but my risk to reward's just not there. Stock market as well. Is the risk to reward there for the stock market? You ever look at the index analysts' actual reports, not what they tell you on TV, but you read through what they're talking about? Every one of them is saying, well, the market's fine, but risk to reward's just not there. The reward is potentially another 5% in 2024, 5 to 8, depending on who you're talking or who's writing the report. The risk is that there's a hard landing, recession, more geopolitical stress, all this stuff. And they're like, that's as much as 25%. So you can't justify starting here when it's not a balanced risk to reward, Mozilla, what part of Texas am I from? I am, see, I even talk like that. I am from Richardson, Texas, originally. Yes, Richardson, Texas. Okay. That's all I got for you guys here today. I'm going to get on going here and wrap these things up. We will be back tomorrow to do this all over again. Then we'll have our wine and wealth. It'll be a great time. Feel free to check us out at jazzwealth.com. I wear this hoodie every day as a form of marketing because we can't afford to do any other marketing. So I hope you guys enjoy. And whatever the heck that is, I will see you later. Adios.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.